this year on something my son introduced me to that I actually am excited about much more than Dogecoin. In November, he asked me if I'd ever heard of ChatGPT because it might spell the end of the school essay. And for those of you who have missed the hype, ChatGPT is the latest iteration of artificial intelligence that can answer questions based on very complex prompts. I laughed when he told me he used artificial intelligence to help him write an essay, but when I had read what it had written about an essay topic, America's liberal political tradition in Ronald Reagan's and Martin Luther King's economic policies, I was astounded. It gave a coherent start to a very specific and complex topic. So it seems like to me that artificial intelligence has finally arrived. Of course, I had to test out ChatGPT's finance chops, so I asked it to pick some stock based on Warren Buffett's investment methodology. And while it came up with some boring responses, I've seen worse stock picks for my teenage sons. It's hard to go wrong with J&J, P&G, and PEP. But upon probing a little bit more, I found that ChatGPT wasn't quite ready for prime time. I asked it to find the best stocks based on earnings revisions, and it came up with A, B, C, D, and E. Bloomberg found the same thing. Not surprisingly, even artificial intelligence can yet outperform the stock market. But there's obviously a huge change coming. We're here tonight to discuss next year's forecast, but I think it's important to keep in mind the next 10 years forecast as well. The world is finally on the cusp of looking very different than it did in the past 10 years. Technologies that have been in their development stages are ready for their prime. Several examples, I recently watched this car drive through the streets of San Francisco by itself with no human in the driver's seat. And while we've all battled COVID, incredible advances have been made in healthcare. The cost to map the human genome has dropped dramatically over the last 10 years. And gene editing biotechnology will make huge strides in the areas of cancer research. Death from cancer, which has already been dropping dramatically, could, in my opinion, be virtually eliminated in the next 10 years. And despite the concerns of environmental scientists, I think we're actually making great strides in reducing our reliance on carbon fuels. Renewable energy now makes up 24% of the U.S. electricity generation, as the cost of renewables has dropped below the cost of traditional fossil fuels in several instances. So, while it might be good to be somewhat judgmental, it's important to realize that many bubbles actually originate not from fraud, but from history-changing innovations like railroads and the internet. And this past bubble could actually launch us into a new era of longer, cleaner, and more productive lives. So while it's fine to worry about the Fed and Russia and earnings, I think the next 10 years will look very different from the prior 10 years. And it's important to understand, plan, and find the opportunities and threats that will arise from those dramatic changes. Thank you, and now on to our speaker. I always like to listen to economists from independent and private equity firms such as Apollo because they don't have anything to sell me. And Torsten has always been an economist who tells it like it is. In April of 2021, he was warning that despite the view that inflation was transitory, that it was actually a risk and would bring the start of volatile markets. And he was exactly right on that regard. Torsten Slok joined Apollo in 2020 as chief economist, and he leads Apollo's macroeconomic and market analysis. Before joining Apollo, he worked for 15 years as economist at Deutsche Bank, where his team was a top-ranked institutional investor magazine, fixed income and equities winner for 5 years in a row. And prior to Deutsche Bank, Mr. Slok worked for the IMF and the OECD in Paris. He has a PhD in economics, and he has studied at the University of Copenhagen and Princeton University. You can get his views every week in a podcast from Views from Apollo, and every day in his daily Spark email, and I encourage you to sign up for both of those. And we're very pleased to have with him today, Torsten Slok.
Well, thank you. Well, thanks so much, and thanks so much for having me today, and thank you for the kind introduction. I started my career at the IMF in Washington, D.C. in 1998. So my wife and I have driven down to Potomac Mills and further down here to Virginia for the better part of our time when we were here, and we, of course, tremendously enjoyed it. So the idea with this presentation is to talk about what's going on in financial markets, and I will start out talking about what's going on in the economy, and then I'll talk about what's going on in financial markets. And I really think it's quite simple at the moment. Last year, as Tom just mentioned, inflation started going up. And with that came, of course, interest rate increases from the Fed. So today the question is there still a risk with inflation? And is there still a risk that those interest rate increases that we have seen, and we literally just saw here yesterday, are going to be a threat to earnings and a threat to growth going forward? And at the bottom line is, and that's the main message in the presentation, is that those risks are now subsiding. In other words, the inflation risk is declining and the recession risk is declining. And I'll show you a number of charts how inflation is coming down, why you should expect it to continue to come down. And I'll show you a number of charts that also are showing that recession risks are also subsiding. I know tomorrow we get the employment report, so we'll figure out where we are exactly right now in terms of the labor market and the latest economic indicators. But the conclusion is what I have written here on the front page, namely, inflation has peaked and recession fears are subsiding. That means that it's time to put money to work. In other words, if you wait with investing in the S&P 500 until inflation is down at 2%, if you wait with investing in the S&P 500 until you have complete clarity about how weak growth will be, and then we have been through any mild slowdown that we have in front of us, you run the risk that markets will be a lot higher. So the reason why markets are rallying today is really very simple. Markets are rallying because there was a huge cloud in finance terms that came in over financial markets in 2022, and that cloud was inflation. And that was the reason, inflation was the number one reason why the S&P 500 sold off. That was the number one reason why credit spreads widened. That was the number one reason why high yield spreads and IG spreads widened. And that was, of course, more broadly the reason why the economic outlook became so foggy overall. But now that that risk is getting smaller, that is exactly the time to begin to put money to work. Not necessarily put all your money to work, say in the S&P 500 today, but think about it from a dollar cost averaging perspective. That inflation will be coming down, as I'll show you in a minute, to the Fed's 2% target over the next 6-9 months. And if that's the case, then if you have like $900, you should put $100 to work every single month for the next 9 months, and then you will be able to capture the bottom with the idea that the risk that everyone was so sleepless over last year is about to go away. And why is it that I'm so certain that this will happen, and what are the arguments why this will happen? Well, the first argument is to look at inflation swaps. Remember, inflation swaps is what markets are pricing today. So this is not the Apollo forecast or whatever, the Fed forecast or consensus forecast. This is market pricing. So if you disagree with this, you can put your money on and bet against this and make money if this is wrong. So let's look at what market pricing is saying today.
Market pricing is saying in the green line that inflation today is 6.5%, and over the next 5 months, inflation will, by the middle of this year, in June, be back at 2%. And why is that so important? Because the Fed's inflation target is 2%. So think about what this is telling you. This is telling you that this risk of inflation that was so prominent last year will soon be gone. This chart is the whole reason why markets went through this huge roller coaster where we had a dramatic sell-off. This chart is the reason why primary issuance and high yield has been shut down. This is the reason why M&A activity has been so weak. This is the reason why IPOs have been shut down. And this is also the reason why venture capital has been doing so poorly. Because when inflation went up, the Fed was raising the cost of capital. And when the cost of capital went up, of course, you came with the consequence that tech and growth and venture capital did so poorly. So this chart here is very, very important for investors because this is exactly the reason why we should become much more optimistic and think about that most of the things that we have worried so much about for the last 18 months are about to get better. If I now turn to the second risk, namely not only inflation is coming down, but also recession risks are subsiding. Well, one way to look at this is to look at consensus expectations to US GDP growth and consensus expectations to European GDP growth. Look at this chart here. This is showing you growth expectations to 2023. If you look at, as we went through 2021, and in particular in 2022, as the Fed raised rates, as Ukraine invaded Russia, growth expectations globally came down. But look at the last several months, growth expectations, including in the US, have been moving sideways. And in the last few weeks, growth expectations have actually started to improve. So this is now telling you that the probability of a recession in the US and in Europe has actually started to decline. So that's another way of saying that not only has the recession risk gone down, but we have also seen the inflation risk start to go down. And that, of course, means that from a market's perspective, if you ask me, okay, so why is it that the S&P 500 is going up? Why is it credit spreads are tightening, both in IG and high yield and loans? Why is it that people are coming back to buying risky assets? Well, the reason why people are coming back to buy risky assets is because we went into this year with expectations of a very, very bad outlook for earnings and a very bad outlook for growth. This chart here shows you, if you read the text below the title, the probability of a recession over the coming 12 months in the Fed's survey of professional forecasters. Remember the Philadelphia Fed, every quarter they ask professional forecasters, what do you think is the probability of a recession? And as you can see, in the fourth quarter of last year, there was a 45% chance that we would have a recession according to the consensus. So no wonder that all investment portfolios were very defensively positioned going into this year, because the expectation throughout 2022 was that, whoa, everything is going to get really bad over the coming quarters. But now that things have really not turned out to be bad, now that the labor market is still strong, now that jobless claims, including today, still continue to decline, now that the unemployment rate today literally is at the lowest level in more than 50 years, and now that the consensus tomorrow expects non-farm payrolls to come in at 190,000 jobs created in January. That's not a recession. That's not barely an economy that's slowing down. So we might actually have a scenario where we're not even having a soft landing, but where we actually have no landing. So that's another way of saying, of course, if positioning going into equities, in credit, in high yield, in IG, in loans, across the board positioning was very defensively prepared for what was going to come in 2022 and in 2023. If we are now going through this year over the last 4 or 5 weeks, and we are not seeing the economic data slow down, we are barely seeing earnings slowing down in this earnings season, then it's not a surprise if everyone was underweight equities and underweight risk going into this. It's not a surprise that markets are rallying because money is being taken away from the sidelines and being put to work as we get more and more evidence that this is most likely going to be a soft landing. So that's another way of saying, when people ask me, and when I have a lot of conversations also internally at Apollo, well, what's going on? Why is it markets are going up? Well, the first answer is because we're just not having that recession everyone expected, and everyone went into this year very, very conservatively positioned. And the other thing that's going on is, well, what about valuations? The multiple on the S&P 500 at the moment is about 17. Isn't that expensive? Well, that may be a little bit expensive, but if we came very defensively and underweight into this year in terms of risk, this theme will continue to dominate until people are back at their weights of where they should be on their pie charts in terms of their asset allocation. So this rally is really, in popular language, a short squeeze where people were so unprepared for the data still doing well. They were so unprepared for inflation coming down that they're now caught offside and therefore beginning to see, well, wait a minute, if we have $4.5 trillion in money market mutual funds, and I'm now looking at equities doing so well, and I'm now looking at credit doing so well, maybe I should be allocating more to risk. Maybe I should be buying some more NASDAQ, buying some more S&P 500, with the idea that this recession seemingly is not materializing, at least not up to this point. So we will continue to see this rally as long as the economy continues to do so well. And that debate is all about inflation, because remember, inflation at the moment is still too high for the Fed to get to their target of 2%. Remember, inflation today, as you can see in this chart here in the green line, is around 6%, because inflation is just too elevated relative to what the Fed would like it to. But one way to look at inflation is to look not only at inflation as a 12-month change in the price index, you could also look at a 6-month change and a 3-month change. And why would you do that? Because remember, with a 12-month window, you include the Russian invasion of Ukraine. And if you don't want to include that and ask, well, what's been going on in inflation since the Russian invasion of Ukraine, you could look at inflation over the last 6 months and inflation over the last 3 months. And if you look in the light blue line, which is inflation over the last 3 months, and you annualize the 3 months change in inflation, you get that inflation in the last 3 months is actually coming down quite quickly. And you get the same message in the dark blue line, which is the 6 months change annualized, and that's also coming down rather quickly. We're not quite yet down at the Fed's 2% target, so we can't quite declare victory yet. This is also what Jay Powell said yesterday at the press conference. We're not quite there yet, but we are absolutely seeing a very nice decline in inflation, and we should expect that to continue. And why should we expect that to continue? Because a number of the leading indicators I'm going to show you now, they point to inflation slowing down. So the green line in this chart here is core inflation. The blue line is the NFIB survey that asks companies, are you planning to raise selling prices of the products that you're producing? And I pushed that 6 months to the right, and as you can see, the correlation is not perfect always back in history, but at least it's very clear that when companies today, just even forget the green line and look at the blue line, companies today are saying, 6 months ago, 50% of companies said, I'm going to raise the price of the product that I'm selling. How is that today? Well, today you can see in the blue line now only around 25% of companies are saying, I'm planning to raise the price of the product that I'm selling. So leading indicators of what inflation will do, leading indicators of corporate intentions of what pricing will do going forward is definitely pointing to the downside. And obviously, in this chart here, the risks are there that this could happen rather quickly, because at the moment, as you can see, there's a very significant downward pull in inflation as a result of a lot of companies saying, well, maybe I'm not going to raise prices that much anymore. Another way to look at inflation is to split inflation into goods and into services. This chart here shows you the green line is goods inflation. And what's goods inflation? Well, goods inflation is essentially everything you buy on Amazon, because goods, that's sort of things you can touch and things that you buy in stores. And as you can see, for the 20 years before the pandemic, goods inflation was literally zero. And why was goods inflation zero? Because we imported everything from China, from emerging markets, and the goods we were buying in Walmart, on Amazon, basically there was no inflation, there was no pricing power, there was no increase in prices of products in the goods space. That changed dramatically when the pandemic came along. As you can see in the green line, we were all sitting at home buying stuff on Amazon, and the more demand we got to Amazon, Amazon couldn't deliver because of supply chain problems. So there was both more demand and there was less supply. So you saw a total unprecedented increase in the green line, where goods inflation went up at the peak 12% year over year. I had never thought that we would ever see those levels of inflation in goods. But now we are no longer buying so many things on Amazon, and the supply chains are getting straightened out. So that's why goods inflation is now coming down very quickly. And that's a very important reason why inflation is coming down very quickly. And instead, we are going out and doing services. We're going to restaurants, we're going to events, we are flying on airplanes, we're going to concerts, sporting events. All those things are still red hot on fire, still doing quite well. That's why goods inflation in the blue line continues to move up. And what's important in this context is that goods inflation has continued to move higher, in particular because of house prices moving higher. And one thing that's very important when we look at the leading indicators is that both for goods and for services, we are beginning to see things also begin to roll over. So this chart here, the green line, again, is just inflation. Now the blue line is ISM manufacturing prices paid index. Remember, in the ISM index, there's a subcomponent for prices. This is asking the question to manufacturers, what's happening to pricing at the moment? And as you can see very clearly, I pushed that 3 months forward, that we're seeing a fairly significant downward pull in prices paid in the ISM, suggesting that inflation is about to continue to go down. You also see that in the supply chains. The New York Fed has a measure of global supply chain pressures. This is, again, the blue line, the green line, in this chart here. The blue line is, again, just inflation. And supply chain pressures are also getting better. In other words, supply chains are getting straightened out. And that's certainly also most helpful for being a downward pull on inflation. If you now turn to services, you're also seeing, in this case, again, the green line is inflation. The blue line is now ISM services, prices paid. This is, again, the subcomponent of ISM, non-manufacturing, where you ask service companies what's happening with pricing. And that's also pointing to more downside risk. And the ultimate piece of evidence, in my view, why inflation is going to come down is because home price inflation is also coming down. And this touches on something very, very important for financial markets. Just to back up, when I meet people who say, well, we're still waiting for the lagged effects of monetary policy to come through. Well, we are already seeing monetary policy having consequences, but it is only the interest rate sensitive components of GDP that are responding. And what are the interest rate sensitive components of GDP? Number one is housing. Number two is autos. The car sector is not doing well either. And number three is durable goods more broadly. This is washers, dryers, furniture. Anything that requires financing is not doing well when interest rates go up. The problem is that those components of GDP only make up 20% of the economy. The 80% of the economy that services is still doing really well. That means that, as we all know, when you fly at the moment, every seat is taken. When you look at the daily data for how many people show their boarding pass to a TSA agent, no sign of a slowdown. When you look at the daily data for how many people go to restaurants, no sign of a slowdown. When you look at the weekly data for how many people are staying at hotels, occupancy rates, no sign of a slowdown. RevPAR is strong, daily rates are strong, occupancy rates are strong. When you look at the weekly data for credit cards, there's some signs, again, of those things that require financing being a little bit weaker, but broadly speaking, consumer spending is still doing really reasonably well. And all that then brings you to the conclusion that yes, monetary policy may have some lagged effects, but you're already seeing the effects of monetary policy in this chart here. The green line is the owner's equivalent rent, and remember, owner's equivalent rent is the component of the CPI that's housing. Remember, housing makes up 40% of the CPI basket. So this chart here, I actually stole this from Jay Powell. He used this at a Brookings presentation in November. And why is it so important? Because the leading indicators of housing inflation are beginning to roll over. You see both in the Zillow Observed Rent Index, the Apartment List Index, and the BLS New Tenant Repeat Index have started to come down. And what does that mean? That means that you should expect to see service sector inflation also begin to come down. So if I go back to the chart here that I had with goods versus service inflation, you should expect to see the blue line begin to roll over and begin to come down over the coming months as a result of housing inflation coming down. So this is very important for the overall outlook, because the conclusion is, again and again in every single chart that I'm showing you, we are not debating anymore if inflation will continue to go up. What we are debating is how quickly will it come down. And this chart here is for wages. Here you have the green line is Atlanta Fed wage growth tracker, and the blue line is the NFIB, another, as you know, survey of small businesses, asking them how hard is it to fill the job openings that you're having at the moment, and that has also been improving. More companies are saying it's not as difficult to fill job openings as it was before. So this is also pointing to wage inflation continuously moving lower. And the bottom line is, I'm going to skip just the final few charts on inflation. The bottom line is the same, that inflation is going to come down, and that's really good news for the following reason. Because if inflation is back at 2% in the next 6 to 12 months, that means that the Fed can begin to spend time on other things than inflation. At the moment, the Fed is so focused on making sure inflation comes down to 2% that if the economy starts falling apart, saying the unemployment rate goes up, the Fed will not be able to say, oh, gee, we got to deal with that. No, they will need to keep their eyes on inflation. But if inflation comes down relatively quickly over the next 6 months, the Fed will then suddenly have the flexibility to say, well, if inflation is back at 2, then we can begin to respond to a labor market that starts to deteriorate. Then we can begin to respond if earnings start to deteriorate, and we can begin to respond if growth in consumption and capex starts to deteriorate. So the bottom line from a market perspective is that for every month we move forward where inflation is coming down and earnings are still okay, and GDP is still okay, and the labor market is still okay, that increases the likelihood of a soft landing, because that increases the likelihood that we will not have that hard correction in earnings, that we will not have that strong correction in the economy, and therefore that we will not have that strong correction in GDP. And let me now just end with a few charts on markets, because the bottom line, as I just told you, is that the economy is just fine, and inflation is actually just getting better and better, meaning ticking lower and lower. So now you should then ask, okay, what does that mean for markets? What does that mean for the S&P 500? What does it mean for credit? Well, one very important backdrop to this conversation is where profit margins are at the moment. This chart here shows you profit margins in the one line as calculated in the national accounts, and the other line shows you profit margins as calculated in the S&P 500. And the message is the same, that profit margins at the moment are essentially at the highest level ever. And why is that important? Well, that's very important because suddenly if we get into a situation where wage inflation may come down a little bit slower than consumer price inflation, that will then mean that wage costs will be higher and selling prices of products will be a little bit lower. That means that we'll get the opposite of what we've been through for the last 2 years, where you actually had that consumer prices were higher than wage inflation. So we could go through a period where wage inflation and labor costs are higher than consumer prices or selling prices. And that would begin to put some downward pressure on margins and some downward pressure on earnings. And that's exactly what we're seeing, and that's exactly how the market has been pricing things at the moment over the last several quarters. And that's what you see in this chart here. The green line in this chart here is the Bloomberg consensus expectations to GDP growth for 2023. So this is asking the 45 chief economists on Wall Street, what do you think GDP growth will be in 2023? And look at it. When the Fed began to raise rates in March of last year, GDP growth expectations came down. Bond investors began to say, well, wait a minute, if the Fed is hiking rates, growth should be weaker. And that's totally fair. That's a fair expectation. If the Fed is raising rates, you should think that growth should be weaker. And you can see that that continued all the way up to October and November when it started to flatten out. This is measured on the left-hand axis. The consensus, as you can see, currently expects GDP growth this year of 0.5. So not quite a recession, but very close to a recession. But what's noteworthy in this chart here is that look at what has happened in the last few weeks. The consensus has actually begun to say, well, wait a minute, maybe growth is not that bad. Maybe we will have a little bit better growth in 2023. In other words, expectations are beginning to stabilize, and the market is beginning to say, well, maybe we will not have a recession in 2023. Now compare that with the blue line. The blue line is S&P 500 12-month forward EPS expectations. In other words, what does the equity market expect will happen to earnings over the next 12 months? And look at how that has reacted for the last several quarters. It went up a lot throughout 2022, and it started seeping down a little bit, but it's really nothing compared to how strong the adjustment was in the bond market. So if I just back up and look at this chart here, I would first say, well, wait a minute, this is totally inconsistent. Bond investors are telling me, oh, this is going to be really bad. And equity investors are telling me, oh, it's not that bad. We're not really correcting our earnings expectations that much. We're just saying maybe a little bit worse, but nothing dramatic. So for a long time, I was saying either the green line has to go up or the blue line has to come down. And I actually thought that it was the blue line that was wrong and the green line that was right. But I'm now beginning to think that, well, maybe equity investors are actually right. Maybe we'll not have that recession. Maybe things are not going to be that bad. If we look around in the goods sector, just to repeat, in the goods sector, housing, very bad. Autos, very bad. Durable goods, very bad. And why is that? Because those sectors are sensitive to interest rates. So everything that's sensitive to financing is not doing very well. But again, that only makes up 20% of GDP. This service sector is doing incredibly well still. Again, airlines, hotels, restaurants, you're seeing very strong data repeatedly come out, both through the earnings season and also on the economics and on the macro front. So the conclusion is, in my view, that, well, maybe we can get through this without a recession because the service sector continues to do well, and the service sector exactly is accounting for such a big share of GDP overall. And the final point on this chart here is that you might then ask, well, how is it possible that we tell one story in the bond market and another story in the equity market? Well, I think that there is a very simple explanation to that, namely that equity investors, they really only care about the last earnings season and the next earnings season. They don't really care too much about what will happen 3, 4, 5 years down the road. But as a bond investor, I don't have that luxury. I need to have a view on what will happen to growth next year, in 5 years, because that's my view on what 10-year rates and 5-year rates should be doing. So in that sense, it's just because institutionally, equity investors just tend to have a shorter horizon. It doesn't mean that that's a better or worse way of doing things. It just means that that's the nature of what you do as an equity investor. And as an equity investor, also think about the following. When I worked at Deutsche Bank, I would go to my colleague who was covering Apple, and I would ask him, how many iPhones do you think Apple will sell in 3 years' time? And his response was, I have no idea. Who knows what will happen in 3 years' time? But my reaction was, well, I need to produce a GDP forecast for the next 3 years. And I also need, as a bond investor, to know what's going on in 3 years. And you're telling me you don't know what's going on the productivity front and on production front in 3 years' time. But I need, as a bond investor, to have a longer perspective. So the reason here why these lines have been diverging as much as they have is, in my view, very, very much to do with the institutional setup that we just have, that equity investors normally tend to focus on a much more short period relative to bond investors that tend to have and are forced to have a much longer perspective. Again, that doesn't mean that that's right, but that does mean that the perspective is just very different depending on which chair you're sitting in. And this is also showing up in vol in markets at the moment. The green line in this chart here is implied vol in rates, and the blue line is implied vol in equities, the VIX index. And look at what's been going on, again, here since 2021. Normally, you would think that the vol measures, the measures of volatility in markets would be moving around together because the things that hit financial markets, say Russia invading Ukraine, COVID, everything that you can come up with of shocks that could come from the outside, say oil prices going up, you would think that that would be moving both the bond market and equity markets around together. But check out how these two shocks have been diverging. Bond investors in the green line have been saying, whoa, there's a lot of uncertainty with inflation, and inflation is a huge risk to rates. So that's why in bond markets, and this is of course from options markets, people have been putting bets on very different things, on putting bets on rates going down a lot and putting bets on rates going up a lot. So the dispersion of views have been very, very wide, which is exactly a different way of saying that vol levels have been very elevated in the green line. Whereas in equities, equity investors, this almost looks like equity investors have been saying inflation. That's not really relevant for me. That's something for people over there in the bond market. And that's so far, it has been the case that the convergence between these two lines has been between bond investors now saying, well, maybe there is no longer this major risk, and that's why vol in rates is coming down. In other words, if we were a hedge fund and you ask me what trade should we be putting on at the moment, I would say we should put convergence trades on here. Either the blue line is going up or the green line is going down, because it cannot be that the story is being told in bond markets and in equity markets are so different and so divergent relative to what's actually going on out there. And it turns out now where the Fed is reaching the peak of the rate hike cycle, and the Fed is coming to the point where they're no longer raising rates, then bond investors are saying, okay, but if that's the case, then I know what the limit to be, how much the Fed funds rate will go up. And now I even also may know how much the Fed funds rate may be going down. So that's why vol is getting squeezed in rates. It's coming down, as the green line is showing, because bond investors are beginning to have much more clarity about what level of rates are we actually going to see during this cycle. Whereas equity investors, in particular with markets going up in the last many weeks, equity investors are saying, yeah, rates are coming down because of that clarity. And if I use my equity risk premium model or dividend discount model or whatever valuation model you have for the equity market, when the discount rate and rates go down, no surprise that the stock market is going up. So with the clarity we are having about the Fed, the clarity we're having about where rates are going is the main reason why the stock market continues to do so well. So if you think the Fed is about to be done, which is firmly my belief, and that's also the market belief, and the market actually believes the Fed will be cutting, so I disagree with that, but I still think the Fed is done with raising rates. Vol should be coming down, and when vol comes down, and therefore ultimately you see less uncertainty in rates, that of course should be a boost still to equities. And the consequence of this for markets is also very important when it comes to credit markets. Think about capital markets for the last 24 months or so. We have basically had, since inflation went up in the beginning of last year, credit markets suddenly shut down. And you saw that issuance in high yield basically went from booming to basically nothing. And what was the reason why high yield issuance went down? Well, the reason why high yield issuance went down was, of course, that the Fed raised the cost of capital. This is page 1 in your textbook. When the cost of capital goes up, it becomes more difficult to do financings. And when it becomes more difficult to do financings, of course, you also begin to see public markets for financings begin to shut down. That's, by the way, as a side note, of course, why a lot of people have gone from public markets and companies are calling us at Apollo and private credit, because there you can get financing, because private credit and private capital is providing the financing that public markets are not willing to do at the moment. And that's, of course, the tailwind that private capital has had throughout this period, because when public markets are shut down, not only, of course, in credit, also IPO markets have been shut down, M&A markets have been shut down, and capital markets more broadly have also been shut down. And that's exactly why private capital has played such a significant role in stabilizing and stepping in when the public markets were not doing well. But this has mainly, so far, been in high yield. If you look at other markets, this is in loans. That has, of course, also been relatively muted, because loans, of course, also are lower rated. If you look at CLO production, which is what this chart here is showing you, has also been relatively subdued for the same reason that when the cost of capital goes up, this is page 1 in your economic textbook, of course, the whole idea is to slow the economy down. The whole idea from the Fed was to slow down consumption, to slow down capex, to slow down hiring, with the idea of ultimately slowing down inflation. The final area where we have not seen a slowdown is, of course, in IG. Issuance of IG has been very strong, as you can see in this chart here, throughout the whole inflation episode. And that's, of course, good news, because that means that the economy is still doing okay, and in particular, again, service sector companies have been able to get financing, especially, of course, again, in the IG market. And that's a very important backdrop for thinking about what's going on, that if inflation comes back to 2% in the next 6 to 12 months, you should expect to see public markets, public capital markets begin to reopen. We're already seeing a little bit of that in the last few weeks. High-yield public markets have reopened. May also see more of IPO markets begin to reopen. And that's, of course, an important tailwind also to the economic outlook looking into the next 12 months. Let me end with just one last chart here, and then I'll come to the conclusion, and I'll stop, and we can have a good debate. And that's just a chart looking at, okay, let's just back up and ask the question. The Fed is now about to pause and no longer raise rates. Historically, when you go back in time and ask the question, how did the S&P 500 perform when the Fed took a break? And this chart here shows you in the green bars, whenever the S&P 500 paused and you started the clock and look at what happened for the next 12 months, the S&P 500 went up 15% in the following 12 months. So where is this recession? Where is this worry, everyone that is talking about so much that the economy is slowing down? If you have a situation where the Fed is now telling me we no longer need to raise rates, we are no longer worried about inflation, We no longer need to cool the economy down. We're happy with how the economy is performing. We're happy with how inflation is performing. That's a really, really strong sign to us in markets that the Fed is telling me that there's no longer a strong need to step on the brakes and cool down earnings, cool down consumption, cool down capex, cool down hiring with the goal of cooling down inflation. So the reason why markets are rallying is because the Fed is coming to the end of the rate hike cycle. And when the Fed comes to the end of the rate hike cycle, that's because they're giving us the green light and telling us things are getting better. The final point that I'll leave you with on this is that you could then say, well, wait a minute, I have all these other reasons why markets should not be going up. And one very important reason on that list is valuations. And I totally understand it, and I totally get it, that valuations may be going higher and higher, and at some point, I will change my view, and we all need to be intellectually flexible and be honest and say, what am I waiting for to change my bullish view? But I'm still telling you, if everyone came into this year underweight, and if everyone is still saying there's about, as I mentioned, $4.5 trillion in money market mutual funds that's gradually being put to work in the equity market and in credit markets for people that are coming to hunt yield, then I just think it's too early to begin to focus on valuations. As much as the S&P valuations continue to go up, as much as the IG spreads continues to narrow, there's still so much money on the sidelines, and there's still this significant underweight of risk, underweight of risky assets, both in the credit side and on the equity side, that I still would wait at least a good while longer before I would begin to change my view and say, now the rally no longer has legs. I still think that the main issue in markets is that the number one thing that's happening is that the inflation risk is getting smaller and the recession risk is getting smaller. So that brings me to the investment implications. And the first page here is investment implications for public markets. And the next page is investment implications for alternatives. And I'm not going to run through all the details here. You can get the presentation. Just talk to Craig Arsenal, my colleague, who's sitting down here afterwards if you're interested. But the conclusion is, I still think that on rates have, of course, gone up, and they may go up once or twice more. It doesn't really matter, in my view, if the Fed hikes again in March or not. What really is the most important thing is that we're getting to the peak of the rate hike cycle. The second thing is that both for credit markets and equity markets, once we get to the peak of the rate hike cycle, I think it's time to put money to work. And what I mean by that is, again, the dollar cost averaging approach of over the next 6 to 9 months. Put some money gradually to work to make sure that you benefit from this rally and you are prepared for potentially a little bit harder slowdown. But if that doesn't happen, the rally will, of course, then just be even bigger. For the dollar, I haven't spoken much about the rest of the world, but I still think the US will stop raising rates before the ECB and the Bank of Japan and the Bank of England. That means that the dollar should continue to go down. And that also means that international equities, and in particular emerging markets, look very attractive if you both have EMFX and international currencies going up, and at the same time valuations both in equities and credit and rates, in particular EM local currency debt, looks relatively interesting because you both have higher levels of yields, and at the same time you also have the currency going up, meaning the dollar going down. So I think the dollar will begin to continue to go down as a result of the Fed coming to the end of the rate hike cycle. On commodities, I haven't spoken about China either. We can debate this during the Q&A if anyone's interested. I still think China reopening will be positive to some degree for commodities. But what's very surprising in my view is that why has that not happened yet? I mean, China announced their reopening in the middle of December, and we have still not seen commodities go up. That's telling you that maybe China needs to burn through the virus before we begin to see that effect. And in the meantime, if global growth is slowing down and all central banks are raising rates, I would still expect to see commodity prices under some downward pressure as a result of global growth slowing. Finally, and this is the last chart, what about alternatives? Well, remember, for alternatives, the question is always, well, if I lean back and say, if I want to make money over the next 3 to 5 years, what should I be doing? What should I be investing in? What are the themes that are going on at the moment that are relevant for how I think about asset allocation? And I think that there are these 5 themes that I have listed here, namely, first, inflation is high. If this view that the consensus has, and the very first chart I showed you, that inflation is coming down, we'll soon be done, everything is fine. If that turns out to be wrong, that's just another reason to be sure that you are in some real asset that is helping you if inflation remains a problem. So in this case, investors can consider buying real estate and infrastructure to protect yourself against inflation. Remember, many real assets have written down in the contract inflation protection explicitly. Short rates rising. This is all about credit and private credit having a lot of opportunities at the moment when markets are shut down. Think about it. A lot of the private credit financings that are done at the moment are done at yields that are much, much higher than where we were just 6 and 12 months ago. And why is that? Because the Fed has been raising rates and because financing in public markets have been shut down. That means that everything that is first lien, senior secured, large cap is very attractive in this environment, simply because private capital can provide the financing and have the right covenants in place to make sure that those financing and the right levels of yields are there to partner up with companies, hold each other's hand with the company and make sure we cross this bridge of inflation and the problems that we're facing at the moment and get through this episode without any major problems and making sure that the companies can survive this challenge that we're seeing in markets at the moment. And of course, with that backdrop, as I've written in bold text here, investors can consider buying floating, short rates, high quality credit. And why floating? Because its short rates are still going up. And why short rates? Because that's where all the action is. Long rates have been going down. So if you're buying floating rate debt, you want to be in short maturities. And why high quality credit? Well, you want to make sure that you're up in quality, because if there is a harder landing coming, that doesn't look like it's the case at the moment, but if there is a harder landing coming, for whatever reason, anything that happens in whatever, Russia, Ukraine, or slower growth in China than we expect, or slower growth in Europe than we expect, you need to be up in quality to make sure, meaning large cap or IG, to make sure that you're protected against the downside risk of a recession potentially being a risk. High volatility in markets. This is all about entry price. Think about the last 18 months. A lot of things have become very cheap. In fact, some things in tech and growth have become so cheap that it's almost value. So that's, of course, also an environment where you want to lean in and buy things while those things are cheap. Let me just bring one anecdote on that. So before I got this lovely job at Apollo, I worked for 15 years with Deutsche Bank, as Tom was saying. And with Deutsche Bank, after the financial crisis in 2008, I was literally traveling around Europe for 10 years. And in every meeting I went to for those 10 years, everyone I met, they said, oh, it's so boring. Rates are so low, spreads are so tight, vol is so low. There's nothing to do. I'm not doing anything. And now I call the same people and I say, okay, so how is it going? I assume you're leaning in. It's a very different environment. And the response I get, and I know many of these people are my good friends, and the response I get from people saying what I'm doing at the moment, oh no, I'm not doing anything. This is crazy. It's totally wild. And I'm just saying, well, you got to be intellectually honest. You got to have some strategy. You did nothing when things were boring. You're also doing nothing when things are wild. I mean, what is your strategy? You got to tell me what is your idea with how you invest. So I'm not saying that anyone should do anything differently today. I'm just saying we got to recognize that things have fallen so much in value in so many parts of financial markets that if you're not doing something now, well, when are you then doing something? That's the problem that I have, generally speaking, with this idea that we're all at the moment hiding under the table and saying, oh, gee, I'm so worried, I want to wait until everything is much, much clearer. Well, be careful what you ask for. When everything is much, much clearer, stock markets are going to be a lot higher, credit spreads will be tighter, and at the end of that process, we'll soon be back in the next year or two to where we were before in the boring environment, where you didn't do anything also. So the conclusion is the high volatility. You have to be careful. You need to do your homework. You need to do the careful work of figuring out what you're investing in. That's, of course, what we do both in our private equity and our private credit business all day long. But you could do that yourself also in public markets. But that strategy needs to be there, that you need to think about, if I'm not buying when things are cheap, then when am I buying? And the final 2 points is on Ukraine, Russia. That's a traditional stagflation shock, higher inflation and lower growth, in particular in Europe. And finally, higher energy prices that will accelerate the energy transition and investment in green energy and renewables. So you should, of course, always be exposed to the energy transition and to climate and to renewables. That's always a good idea, and that's particularly also a good idea when sanctions probably are going to stay in place, and therefore energy prices are going to remain elevated, potentially for quite some time. So the conclusion is, and let me just bring it back to the very first page that I showed you here, that I think that there are certainly a number of things, as I just spent a good deal of time on talking about here, to worry about. But I do think that the major backdrop for any conversation about asset allocation at the moment is that the main thing that I worried so much about last year, namely inflation, we were all sleepless over what inflation was doing to our portfolios. The 60-40 portfolio did horribly because inflation went up. And now that inflation is beginning to come down, I need to think about what is my strategy now? What am I doing with my money? Because now inflation is getting down, and I showed you a number of charts why that is likely to continue. And on top of that, it even sees that we may, at least at this point, be able to get through this without a sharp recession. And if we're going to go through this without a sharp recession and a deep correction in the stock market and a deep correction in earnings, you also need to think about what does that mean for my asset allocation. That's why I'm saying here very, very carefully, that's why I think it's time to put money to work. So with that, let me stop there and let me see if there are any questions. Housing stocks. Yeah. So the very important reason why home builders continue to do so well, and also housing materials, is that the home builders and the housing industry generally went into this very, very well prepared. The main thing that was very critical about the housing industry going into the last 2 years was that the inventory of homes for sale was very, very low. So when demand increased dramatically during the pandemic, you did not see a spectacular increase in home builders' attitude. They basically increased their production a bit and increased also the production of multifamily, but the home builders and the housing industry, broadly speaking, came into this with much, learning all the lessons from 2006, 7, and 8, with much better balance sheets, much more prepared in terms of inventory, and ultimately also much more prepared potentially for mortgage rates going up. So I completely agree with what you're saying. I have also been surprised at how well the home builders have traded, including also the last few weeks. And most importantly, what has also surprised me from my macroeconomic chair is that, to my huge puzzle, I still don't quite understand that the number of people working in construction is still going up. Despite everything we've seen for the last 12 months, housing firms are still hiring workers. The construction employment numbers continue to go up. So that's telling you that the home builders are looking at everything and saying, you know what? First of all, we still have a pipeline. Remember, it takes on average 6 to 8 months to build a house. So you could say there's a lagged effect. So potentially they may begin to lay off workers. But the good news is that the NAHB home building sentiment indicator actually turned up last month. And you're beginning to see with the mortgage rate going down from the peak at 7.5 to now closer to 6.5, mortgage rates have also been coming down. That's still very, very high relative to the 3% mortgage rate we had during the pandemic. But it's still telling you that the answer ultimately to your question is that the fundamentals in the housing market this time around were much, much better than the fundamentals we had in 2006, where you had a huge bloated inventory of homes for sale, and we now today only had 25% of that same inventory of homes for sale.
Thanks for the comments tonight. Maybe just to think forward beyond 12 months or a couple years, just curious what your take is on economic progress for the next decade and sort of onshoring, deglobalization, all these various effects that are taking place, and what do we have like in store for maybe the next decade plus?
Yeah, so not to bring this to the CFA textbook, but think about it the following way. If you think about the production function of what is it that creates growth in this economy, or in any economy, it is capital and labor. The problem is that labor is not looking good. On labor, we have bad demographics. We have an aging population. We have had, at least up until recently, immigration that was much lower than it has been for previous decades. So we're not seeing the increase in the labor force participation rate. We're seeing an aging population. And if you have, think about Japan, demographics that go against you, that means exactly that the long run prospects, the 5-10-year prospects are just not good. The good news is the US in this competition is the cleanest shirt relative to Europe and Japan. So it becomes a little bit of discussion about, okay, what about global asset allocation? Could it be that people end up saying, as bad as the demographics are in the US, you could still see more money allocated to the US economy simply because Japanese demographics are so much worse and European demographics are not quite as bad as Japanese, but also pretty bad. So on the labor front, you should absolutely expect that things will get worse, and therefore the potential growth rate of the US economy that historically, according to the Fed, has been around 2.5, is likely to go down to 2 and may even go down to 1.5 over the next 10 years. So I am worried about what you're saying, that we will see growth come down purely because of labor. being more of a challenge. And as a footnote, remember what that means, that if the potential growth rate comes down, that also means that the equilibrium interest rate comes down, and therefore our star, which the Fed currently calculates to be 2.5, meaning the level of where the Fed funds rate will be in the long run, will be even lower as a result of that effect. So there's certainly something to rates also be under pressure for demographic reason. And it doesn't get better for the other reason you mentioned, namely the K. Think about, again, production is a function of capital and labor. And what's going on with the K, meaning the capital? Well, the problem is now that if we no longer can import cheap things from China, if we no longer can trade and produce cheap things in China, and we now have much more onshoring, and everything that I buy, toys for my kids, my suits, my ties, have to be produced in the US, that means that the cost of production of everything that we buy is at risk of going up. And if that's the case, that also means that capital formation is also at risk of being weaker. So another way of saying that in reverse is that during the globalization period that we had essentially from the mid-1980s up until here, basically 2010, 2015, that globalization period where you could just produce wherever you wanted, you could get the cheapest widget, just-in-time management of inventory, all that stuff might be taking a back step, and we might be seeing much slower progress on that front, which comes with the ultimate answer to your question that maybe the K and capital formation is also going to be challenged for other reasons than demographics, but simply because the political winds are blowing in a direction now that this is just not going to be possible anymore. So that also means, if I think about what does that mean for growth and therefore for the level of rates, that the long-term prospects globally, but in particular, of course, in the US in this case, is going to be more challenged as a result of the policies that politicians, not only in the US, also in Europe, are just putting in place at the moment. And that's another way of answering your question and saying that the growth prospects are definitely challenged if you think about it over a 5 to 10 year period. Yep.
Tom Phillips with UBS Institutional Consulting. What is your view on the environmental, climate change, and its impact on equities?
So this is very important. Obviously, I could have added that to the question we just got in terms of capital formation, that if there is, in very plain English, too much pollution, then that will be a problem for capital formation, and that will be a problem for productivity. That will be a problem for therefore creating growth. That's why a lot of growth is now being expected to come from energy transition, from renewable energy, from windmills, from everything that you can imagine in terms of creating energy from different sources than fossil fuels. The problem, as we all know, and we saw that with Ukraine, Russia, is that that transition is going to take not only 10 years, but more like 20, 30 years. So that's why even if we tomorrow said, hey, like the Inflation Reduction Act was saying to some degree, we want to invest a lot more in climate, in preventing climate change and make sure that we get much better energy from much cleaner sources. The problem is that the investment in fossil fuels has been very, very low. And when we suddenly then out of the blue have a shock like we had with Russia invading Ukraine, that meant that we just couldn't get the energy from Russia that we used to. That meant that fossil fuel prices and energy prices just went through the roof. And we are likely to see episodes, not of course driven by anything as the geopolitical risk that came with Russia and Ukraine, but for other reasons we're likely to see similar episodes where if no one invests in fossil fuels today, then it's just going to be a fairly bumpy road where we could have a number of spikes to gas prices and natural gas prices and oil prices as we go along, simply because it's going to take so long to get to that end point that we all would like to get to. So the short answer to your question is that this is both important in terms of capital formation, because we should expect more capital formation from renewables, which of course is what we all think is a good idea. But it's actually also important because you become more vulnerable to shocks if you suddenly from one day to the other decide to not invest in fossil fuels. And that creates these shocks that we just have been through, where we saw energy prices shoot up as a result, in this case, of a geopolitical shock. So it is a very complicated road ahead in terms of the energy transition, but we obviously have no other choice, but that's just the reality of the situation that we're in at the moment.
I think we have time for one more question, if anybody's ready. Sorry, Matthew.
Hello. You talked about the kind of strength of the service industries, and you kind of sounded shaky on consumer financing. Are you worried about that, or would you suggest a lower asset allocation to those kind of sectors?
So at the moment, I still think that the Fed is going to keep rates elevated for a while. So if we were a hedge fund and you were asking me, how should we allocate money if the Fed keeps rates elevated? I would say you should still be short the sectors that are interest rate sensitive, because the Fed is not going to cut rates anytime soon, and then be long the sectors that are less interest rate sensitive. So I would look at my portfolio or my pie chart with the glasses of saying, okay, what's most sensitive to interest rates staying elevated? The market is pricing in the OIS curve that the Fed will cut rates in July. I think that's very, very optimistic, because we're just not going to see inflation quick enough back to 2% by that time. So that's why I think the Fed will probably continue, and this is what all FOMC members are saying, by the way, continue to keep rates elevated. And if that's the case, that means that the sectors that are sensitive to interest rates will just continue to, quote unquote, do all the work. All the work now has to be done in terms of cooling the economy down in those sectors that are interest rate sensitive, whereas the service sector just seemingly continues to do well. So that's why at this point, today where we're standing, I still think it's a little bit too early to take the champagne bottle out and say, okay, now I'm just going to buy all the interest rate sensitive components because now inflation is done. Well, wait a minute, let's just wait until the point when the Fed begins to signal more clearly that they are actually done. Because at the moment they're fighting the battle with the market of saying, we want to keep rates elevated. We're not going to cut rates in July. I mean, July is just now 6 months away. It seems incomprehensible that they will cut in 6 months, but that's nevertheless what market pricing is saying. Finally, I should say, as Tom also mentioned, I write, here's a little commercial break. I write a daily email with one chart and a few sentences. If you want to sign up for that, just let Craig know here or come to me here at our table down here. But otherwise, thank you so much for having me today.
Thank you, Torsten. And you've said something that I've never heard in my life, that equity investors might be right and bond investors might be wrong. So I will take that away from your presentation. We have a little gift for you.
That was very nice. Thank you so much.
And again, a round of applause for Torsten. Thank you all for coming tonight, and we'll see you again next year.